Okay, everybody, it is me, Gregory Mannarino. It is Friday, August 5th, 2022. People, right now, and I want you to see this with your own eyeballs, okay? Believe your own eyes. It's the truth. The 10-year yield is spiking, and this is putting pressure on stock futures. We are at 2.80. Now, again, look, in the grand scheme of things, a 2.80 10-year yield it's laughable and it's incredibly suppressed. However, we have watched the 10-year yield spike from about 2.52 to 2.8 in just a matter of a couple of days. And this is going to rattle the markets just like last time. Keep this in mind. It's really not so much what the number is. It's the pace at which it is rising. So to me, and I've been speaking about this for the last couple of days, there is instability in the debt market, and it seems to be manifesting itself right now. Understand what I'm speaking about. Unless central banks, in this case the Federal Reserve, doesn't get into the debt market and start buying more, well, this is it. You're going to see this go from 2.8 to 2.9 to 3.2 to 3.5, bang, and it's going to destroy the stock market. It's going to destroy it. So you and I need to keep our eye on that freaking 10-year yield, period, okay? Here's my take on this. Monumental move here in the 10-year yield in just a couple of days. Almost a 30 basis point jump. It's huge, okay? Now, do I believe that central banks are about to allow the market to melt down? Is this the time? I don't think so. My best guess, and I could be wrong here, and I want to hear from you. Please comment. My best guess here is the Fed's going to do more. Why is the Fed going to do more? Because they're not done inflating. That is the goal of central banks. You know what the European Central Bank is already doing. It's no secret. Unlimited bond buying across the entire Eurozone. The Fed must follow suit here. These two central banks work in tandem all the time. One bank does something, the other bank follows suit here. Now, the last time you and I watched that spike in the 10-year yield, that was the day, there's no coincidence here, that the European Central Bank jumped in and said they were going to start buying bonds on an unlimited scale. The Fed did not make any announcement, but you watched what happened to the 10-year yield, okay? They don't have to say it, okay? Just believe your own eyes. This move here in the 10-year yield over the last few days, right, at 2.8, should really raise your eyebrows. Again, it's not the number, it's the pace at how we're getting here. And as I said, stock futures are lower here. It's ironic. We just got some piece of great economic news. Fantastic. Yeah, private payrolls number came in 2 times higher than expected. That's very interesting. So let's put that into perspective. So we got this phenomenal, miraculous number here with regard to private payroll. It's not real. And stock futures are nosediving. That's because of the 10-year yield, people. What else happened? Well, yesterday, let's put a little more perspective on this. We found out that first-time unemployment claims, I forgot to mention this, came in an 8-month high. So they want us to believe, okay, that first-time unemployment claims come in at an 8-month high just yesterday. But today, this private payrolls number is twice what they expected. Look, it's all fake. The data is not real. But what is real is what you can see with your own eyes, because these numbers, they just conjure them up, whatever they want to do. But what is real and is in front of your face, although it's artificially suppressed as it is watching the spiking here in that 10-year yield. And the dollar, you're watching the dollar knee-jerk higher this morning. Okay, we'll see how this plays out. Like I said, if we continue to see that 10-year yield spike, okay, then we know that it's over. We know it's really over for the market, and we can expect it to fall precipitously. If, in fact, you start to see that 10-year yield drop, Okay, then we know the party's not over. And the other major thing that you and I need to keep our eyes on, and I watch this myself, even though it's my own freaking indicator, is the Mannarino Market Risk Indicator. Link in the description of this video. It's 100% free. Just click on it. It's right there. Right on my website, just scroll down just a slight bit and you'll see the MMRI. The MMRI has been dropping precipitously lately, meaning risk has been dropping in the market. But I would expect to see the MMRI spike this morning, probably substantially. So let's keep our eye on the MMRI as well. So let's step back a moment. I already told you about the 10-year yield. Keep your eye on that. Stock futures lower. Crude oil still under pressure here. When crude falls, people die. You know that. Expect a false flag. Expect some kind of event to prop up crude oil. That's the way it works. Dollar stronger, like I said. Gold and silver under pressure. Cryptocurrency, Bitcoin hovering around 23,000. That's where we stand today. What else can I tell you? This is the story. This is where we are. Okay, I think you and I have a really good perspective on what to do. The number one thing, I'm just going to beat it like a dead horse to keep your eyes on today. If you're a lion, you're one of my lions out here, or even just one of my friends, keep your eyes on the debt market, okay? It's the key to this entire thing. How can I say this enough to you people? Forget the stock market. The stock market derives value from action in the debt market. Therefore, the stock market is a derivative of action in the debt market. So when you see a move like this in the debt market, 10-year yield more specifically, that should say something to you. All right. So with that said, I don't think there's much else to speak about other than the fake data, which is totally it's absurd. Oh yeah, first-time unemployment claims yesterday come in 8-month high, but today private payrolls, oh fantastic, it's miraculous, came in twice as high as they expected. Anyway, you know the deal, people. No one knows this better than you. The distractions, the distortions, the propaganda, the lies. It's out of control. But look, that should tell you something too. When we exist in an environment like this, when anyone is existing in an environment of lies, it should really tell you who's in control here, and nothing is what it seems to be. I don't know another way to say that. Just I want you to be ready. Expect things to unfold here in a worst case scenario. Let's just say, for example, if we do end up seeing a spike in this 10-year yield and it doesn't stop, beyond the stock market, okay, which will take a massive hit here, okay, that's the grand scheme is eventually, and who knows when, this market's going to crater. And I'm talking about a massive crash here beyond anyone's wildest dreams. But instead of picking these out every single month like these so-called crash callers do, you can watch this and understand it yourself just by watching 10-year yield, MMRI. That's it. Okay, we got it covered, and we will act accordingly. We're already doing that. We're betting against the debt. We're becoming our own central bank here, because what's going to happen here? How can I say this another way too? Think about what I'm going to tell you. Eventually, we're going to get an implosion here in the debt market. Uncontrolled spike in the 10-year yield. Central banks are going to allow it to implode, okay? I don't think they're done. Could I be wrong? Absolutely. I believe the Fed's going to take action. The Fed's going to jump in here and start buying more debt, just like the European Central Bank. What did they say? They're going to expand on an unlimited bond buying program. How do you do that? I don't know, but that's what they said. I'm not making it up. Look it up for yourself. So understanding that, that's the key. That's the key. We don't have to speculate when the crash is going to come. All we got to do is watch the 10-year yield. Watch the MMRI, and you're going to know what's going on. So we don't have to sit here and guess or just throw darts at a board every single month like the monthly crash callers. You know exactly who I'm talking about. Anyway, we got it down. We have a plan. We know what to do. This guy here loves you a lot. I mean that. Please comment here. Comment on what I covered. Do you see things the way that I do, or do you see things differently? Just because you might have a different perspective doesn't mean I'm right and you're wrong. I want to learn from all of you. We learn from each other. This is a big family here, a humongous global family, this blog. It's tremendous. And we can learn from each other. Okay, I'm just throwing out my best guesses here. We've seen this happen before with the 10-year yield. We watched central bank action. Do you believe, here's the question. Here's the question I want you to answer. Do you believe that central banks are going to jump in here, European Central Bank and the Fed, and start buying more debt, which is obviously massively inflationary? You're not supposed to know that. But do you believe that's going to happen? Or do you believe that now is the moment? Central banks are going to allow this whole thing to implode. I promise to read the comments, and that is the question. I'll see you at the end of the day.